Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared.
It's good to be here. And today we are wading into waters that, let's be honest, most business owners really try to avoid.
Oh, you can say that again. I mean, if you walk up to an entrepreneur, someone who's really passionate about their product, and you ask them, hey, how's your monthly bookkeeping going?
Yeah.
You're going to get one of two looks. It's either a totally blank stare, or it's a look of just, pure panic.
Right. It's seen as the most boring part of running a company. It's the administrative tax you pay for being your own boss.
What?
Or that's the perception, at least. A chore. Just record keeping.
Something you do because you have to. Because the IRS says so.
Exactly.
Yeah, it's like the vegetables of the business world. You know you're supposed to do it, but what you really want is the dessert, the revenue. But looking at the source material for this deep dive, that way of thinking seems, well, incredibly risky.
Risky is putting it mildly.
It feels like we need to completely reframe this whole topic. We aren't just talking about, categorizing receipts. We're talking about turning this really mundane task into a strategic weapon. And specifically, why that shift is so critical as we're all staring down the barrel of 2026.
That date, 2026, that is the anchor for this whole discussion. The ground is literally shifting. But before we even get to the future, we have to look at what people are doing right now. The central problem we see is that most owners treat bookkeeping as a historical event.
You mean like looking back at a high school yearbook?
In a sense, yeah. They treat it like an autopsy. They wait until the patient is dead or, the year is over. They wait until February or March, dump a year's worth of stuff on a desk and say to their accountant, okay, tell me what happened.
Right. Tell me the score of the game we played last year.
Exactly that. It's the annual cleanup mindset. And the research is clear. This isn't just stressful. It creates this massive drag on capital.
Okay, unpack drag for us, because that sounds like it costs actual money.
It absolutely costs money. It's money lost to inefficiency. When you only look at your books once a year, you're paying a premium for that delay. You miss deductions, you overpay your estimates, which hurts cash flow. You just lose the ability to pivot.
Especially in this economy.
In this economy where margins are so tight that drag can be the difference between, growth and just stagnating.
Okay, so let's get into the mechanics. We need to move from compliance, just doing it because you have to strategy. How does that actually work?
Well, think of it this way. Bookkeeping used to be a scorecard. You played the game, and then at the end, someone told you if you won or lost. But the modern tax environment is dynamic. It is not a static set of rules anymore.
When you say dynamic, are we talking rates changing, or is it more about enforcement?
It's both, but the really key thing is the timing of opportunities. I mean, if you take one thing away from this deep dive today, it should be this. Tax savings are perishable.
Ooh, I love that phrase. Tax savings are perishable, like fruit.
Precisely. They have an expiration date. So many deductions, credits, strategic moves, they require action during the tax year. If you wait until the year's close, those opportunities are gone. They've expired. You can't go back to last July and make a different choice.
So if I'm doing my annual cleanup in March, I'm basically looking at a history book. I can't edit the story. I'm just reading the ending.
You're powerless. You're just tallying up the damage. But if you have monthly bookkeeping, you are in the game while it's being played. You can still influence the final score.
Let's ground this in a real example, because strategy can sound like a buzzword. What does a real-time adjustment actually look like? Say it's October, I have my September numbers. What can I do that the annual cleanup person can't?
Okay, perfect example is asset purchases. The tax code, things like Section 179 or bonus depreciation, it lets you write off big equipment purchases immediately, but there's a huge catch.
What's the catch?
The equipment has to be placed in service before the end of the year.
Placed in service. So I can't just order it on December 31st and get the deduction.
Yeah. Nope. It has to be operational, working. If you order a new server rack on December 30th and it doesn't get turned on until January 5th, you get zero deduction for the previous year.
Oh, wow. Okay.
So let's say we know in October that you're having a huge year. Your profit is way up. Because you have the data now, we can have a real conversation. We can say, look, you're facing a massive tax bill. Go buy that $50,000 van you need, but buy it now.
So it's on the road by November.
And boom, you just knocked 50 grand off your taxable income. But now think about the alternative. The annual cleanup person, they don't know their real profit until March. They file, they owe the tax, and they still have to buy the van this year anyway. It's a double hit. All because they were flying blind.
That's a painful example. It really just shows that visibility is the prerequisite for strategy.
Yeah.
You can't steer a ship if you can't see 5 feet in front of you.
And it's the same for cash flow. If you see a crunch coming 3 months out, you can get a line of credit while your books look good. Try getting a loan when you're already in a hole.
Right, bankers don't lend to question marks. It's playing with your eyes open versus driving with a rearview mirror.
Which, usually ends in a crash.
Speaking of crashes, let's talk about the shoebox approach. I feel like every entrepreneur knows this one. That literal or, digital pile of receipts you just ignore.
The shoebox. It's a legend in accounting. And it is, I would argue, the single biggest destroyer of wealth for small businesses.
That is a very bold statement. Destroyer of wealth.
Absolutely. Because of data integrity. When you try to reconstruct a whole year of activity in a 48-hour caffeine-fueled panic, things get missed. It is a statistical certainty.
What kind of things? It's not just a few coffee receipts, right?
Oh, it's so much bigger. It's the recurring software subscription you forgot about. It's the business lunch you paid for with a personal card. It's cash payments. When you just scan bank feeds a year later, you lose all the context. You forget why you spent the money.
And every single missed expense is.
It's phantom income. You are paying tax on money you already spent on your business. You're basically giving the IRS a voluntary tip because your records were sloppy.
Nobody wants to tip the IRS.
Nobody. But beyond the money you lose, there's an even darker side to the shoebox, and that's the audit factor.
The A word. The one nobody wants to hear.
The IRS is very sophisticated now. They have data matching algorithms. If your tax return shows a profit margin that's wildly different from others in your industry because you missed half your expenses, that is a giant red flag.
So your sloppy books are basically raising your hand and asking for an audit.
In a way, yeah. And if they do audit you and your whole system is a shoebox full of faded receipts, you lose. The burden of proof is on you. Monthly bookkeeping creates that clean paper trail. It's your insurance policy.
Okay, let's unpack this idea of proactive tax planning. We hear that term a lot. How does this monthly habit actually unlock that?
It all comes down to the variable income problem. Most businesses don't make the same amount of money every month. It's feast or famine.
Some months you're the windshield, some months you're the bug.
Exactly. Now think about your estimated tax payments. You have to pay those quarterly. If you're basing them on last year's numbers, but you're having a really slow year, you're just overpaying the government. You're giving them an interest-free loan.
And that's cash that could be in your business, buying inventory, or making payroll.
Precisely. If we look at the books in June and see you're down 20%, we stop the estimated payments right there. We recalculate. We keep that cash in your business. And the reverse is true, too. If you're way up, we increase them so you don't get hit with a big underpayment penalty.
Which can be huge.
It's just wasted money. It's lighting money on fire. Proactive planning is also about having levers you can pull.
Levers.
Strategic choices, for example, timing your income. If you're on the cash method of accounting and it's December 28th, maybe you wait to send that big $20,000 invoice until January 1st.
And push that income into the next tax year.
Defer the tax for 12 months. It's a classic lever, but you only pull it if you know exactly where you stand. If you don't have the data, you're just guessing. And in tax law, guessing is always expensive. The goal of all this is simple. No surprises.
No surprises. I think every business owner would pay for that peace of mind. But let's look beyond the IRS. Businesses operate all year long. How does this help with just keeping the lights on?
This is the operational side, and it's huge. We get so focused on tax, but there's a massive difference between profit and liquidity.
The classic, I'm profitable, so why is my bank account empty? Problem.
It is the silent killer. You can show a great profit on your P&L statement, but if your clients aren't paying you or if all your cash is tied up in inventory, you can't make payroll.
So you can literally go bankrupt while being profitable on paper.
Happens every single day. Monthly bookkeeping forces you to reconcile the bank account. It shows you where the cash is really going. It reveals trends.
What's a trend that an annual review would totally miss?
Margin creep. Let's say your supplier raises prices 3% in February. Shipping goes up 2% in March. They seem small. But if you wait until the end of the year, you've been eating that 5% cost increase for 10 months straight. You've lost that margin forever.
Whereas if you saw it in April, you could have adjusted your prices in May.
Exactly. You catch the leak before it sinks the entire boat. This is about being agile. Can I afford that new hire? Can I move to a bigger office? You answer those questions with data, not just a gut feeling.
Okay, I want to pivot now to the 2026 part of this. The strategic foundation for 2026. Why that specific year?
It's a very, very specific and high-stakes year. We are fast approaching what some people are calling the Great Expiration.
The great expiration. That sounds
Yeah.
a little ominous.
It is serious. It's the sunset of many provisions from the Tax Cuts and Jobs Act, or TCJA. So unless Congress acts, and, relying on Congress is a risky bet, tax rates are scheduled to snap back to where they were before 2018.
So for a lot of people, taxes are going up.
For many, yes. And that 20% pass-through deduction that so many small business owners rely on, the QBI deduction, that could vanish or change dramatically.
So the environment is about to get a lot harsher.
Harsher and way more complex. The only way to prepare for that shock is to have crystal clear data now so we can model different scenarios. But there's another piece to this, especially for modern businesses, the digital layer.
What do you mean by that? Like digital payments?
The payment platforms. The IRS is drastically lowering the reporting thresholds for platforms like Venmo, PayPal, Stripe, Cash App.
Right, I've heard about this.
For a long time, side hustle money could kind of fly under the radar. That's over. The reporting is getting much tighter. If you are mixing your personal and business transactions on Venmo, you are walking straight into a minefield.
Because the IRS computers will just see all of it as income.
They'll get a 1099-K form for your account. Let's say that form says you brought in $80,000, but your books say $60,000 because 20 grand of that was just friends paying you back for pizza.
The IRS assumes it's all income.
And now the burden is on you to prove that it wasn't. If you don't have clean monthly records separating those transactions, it's a nightmare. The margin for error is just shrinking to zero.
That really changes things. It's not just about being organized anymore. It's about surviving a digitized audit environment.
It is. The cost to untangle a year of commingled Venmo payments is astronomical. You do not want to pay a CPA their hourly rate to figure out which payment was for your cousin's birthday gift and which was a business transaction.
That's a great point.
Yeah.
Is pay a little now to maintain it, or pay a fortune later to fix the disaster.
And that leads us right to the relationship with the CPA, the advisory advantage. How does this monthly process change that dynamic?
Yeah, because most people just see their CPA as the person they hand a bunch of papers to once a year.
It completely flips the value proposition. If you only see your CPA once a year with the shoebox, they are a compliance machine, a factory worker. They take your stuff, they process it, they spit out a tax return.
It's very transactional.
Totally transactional. But when you have clean monthly data, the CPA moves from preparation to interpretation.
Interpretation. I like that.
We stop looking at the past and we start modeling the future. We can look at your numbers in August and say, hey, your labor costs are trending up faster than revenue. Let's fix that now. Or you have a big cash surplus sitting here. Let's set up a plan to shelter it from taxes.
So they become a partner. Someone helping you steer the ship, not just checking for holes after you've already docked.
And the monthly bookkeeping is the ticket to entry for that kind of relationship. You cannot advise on a cliff you can't see. If a client hides the data, our hands are tied. We can only report on the mistake you made 6 months ago. We can't prevent it.
It's the difference between having a historian and having a navigator.
That is the perfect analogy. And with 2026 coming, you definitely need a navigator.
This has been incredibly comprehensive. I mean, we've gone from the shoebox of doom to the great expiration. If we had to boil this whole deep dive down to just 3 key takeaways for our listeners, what would they be?
Okay, I think it comes down to this. First, monthly bookkeeping is the fuel for tax planning. You literally cannot do effective tax planning without it, period.
No data, no strategy. Simple as that. What's number 2?
Number 2, it is your best defense. Accurate, timely books reduce your audit risk, and they protect you from that digital dragnet with Venmo and PayPal. It keeps the money you earned in your pocket.
Right. And the third?
Third, it unlocks the advisory relationship. Stop paying your CPA just to file forms. Use that data to get high-level guidance. It shifts you from being reactive, cleaning up messes, to being proactive and building wealth.
Building wealth, not just cleaning up messes. I think that's the mindset shift we're talking about. It really does turn bookkeeping from a chore into a competitive advantage.
It's the smartest investment a business can make heading into 2026.
Well, there you have it. Monthly bookkeeping isn't just about satisfying the IRS. It's about empowering you as the owner. I want to leave you with this thought. If you're listening to this and you realize your current approach is more shoebox than strategic, don't panic, but do take action. The year 2026 is coming fast, and the rules are changing. If you want to move from compliance to advisory and learn how to get your financial house in order so you aren't leaving money on the table, you can learn more by visiting the team at mwwcpa.com. That's a conversation that will pay for itself. Thank you for joining us for this deep dive. Keep your business compliant, profitable, and prepared. We'll see you next time.